Alright, today we're looking at multi-time frame analysis. So how we analyze the market on different time frames. We're going to be having a look at the different types of traders and what time frames they look at, how to get higher quality setups, and how the candlesticks and market structure correlate on different time frames. So what is multi-time frame analysis? Multi-time frame analysis is when a trader looks at the same market on a different time frame to get a better idea of overall trend and choose the best time to enter or exit a trade. So you'd usually look at a higher time frame first of all, and then look at a lower time frame, maybe to get a better entry or a better exit for your position. So using multi-time frame analysis helps traders understand the bigger picture while fine-tuning our entries and exits for better precision and risk management. Multi-time frame analysis helps us identify market trend, spot key levels, spot better entry exit points, and it's essential to use when making your trading plan, especially when it comes to automating it. There's three types of traders that we have. So we have the scalpers, which look on low time frames and they're catching very small moves, usually using a bigger lot size so they can actually make their money. I do a bit of scalping on the market opens for the Nasdaq and UK 100, so London and New York opens. So scalping is a technique that I use, and I also use swing trading by dollar cost averaging in the market, which is actually what my bot does, and it's very profitable. So this is a really good choice if you're still working full time as well, because most of the time you're looking at hourly, 4 hourly, and daily time frames. Same with intraday as well. Scalping, you got to be looking at the market a fair bit to get your entries. So if you've got a full-time job, swing trading is a good choice. The best way to analyze the market is to use multiple time frames. However, they need to be used in conjunction with each other to avoid confusion. Let's see how we can use it to help us extract money from the market. There's so many different time frames we can look at for market movement, all the way from M1, believe it or not. So you can look at the 1 minute chart all the way to the weekly and monthly charts. So with all these options, traders often suffer from paralysis of analysis, meaning there's so many places to look at, it'll give us different signals on every time frame we look at. So we'll see a different picture on every time frame. Depending on your trading strategy, it's wise to stick to the time frames that you have in your rules. So this comes back to sticking to your rules, and you got to stick to your rules to become profitable. For example, you may see a great head and shoulders pattern at a support level to take long on a 15-minute time frame. So this would be a short scalpy move. But you change it to the 4-hour chart and you see the market has been crashing for days or weeks. So now you're thinking it's going to come up because it's got a nice reversal pattern, but it's coming down long term. So you could catch a quick leg up, but you see this and it scares you. You don't take the trade. So you don't enter the trade and price rockets up. You would have hit your TP, but you didn't enter it because you got scared. You got paralyzed by analyzing too much. Using multi-time frame analysis the wrong way can create confusion instead of clarity. So the top mistakes are looking at too many time frames and just overcomplicating it. If you overcomplicate it, you're going to suffer. You're going to close out positions too early or just get stopped out constantly. So price will be moving the same way on all time frames, but the lower the time frame, the more chop you'll have, and you'll find the signals and systems are less reliable. A 3-bar reversal pattern on the M5 isn't as strong as if you were to see it on the H4 chart. So the daily is a slow time frame and trades take a long time to play out. So this is like swing trading and intraday trading. The H4 has slightly faster oscillation, so you'll get more trades, and it still offers pretty reliable signals. The H1 is even faster but less accurate, and so on with M15, M5. So the lower the time frame you're looking at, the less accurate and reliable your signals will be, not only with market structure and key levels, but also with candlestick patterns. So how can we take advantage of all these time frames? Given that signals and strategies on the higher time frames tend to be more reliable for determining an overall direction for price, it makes sense for us to focus our analysis on a higher time frame, doesn't it? However, we can use lower time frames to help us get our entries into trades. This often allows us to make more profit because we get more entries as larger time frame ideas play out. Let's just assume we wanted to trade just using RSI extensions over 70 and below 30. So if price is up on the RSI, it's overbought, so we're expecting some sort of pullback down. If RSI is oversold, we're expecting some sort of pullback up. Let's see how many opportunities we get on two different time frames. First of all, the H4 and then the M5. So here we go. This is on the H4, the 4-hour chart, and this is 6 months worth of data. So as you can see, we hit the 70 or 30 levels 10 times in 6 months. So we have 70 and 30. So in 6 months, we got 10 taps of these levels. So we had our first one here, which would have been a nice buy up, entry for a long. Over here, ooh, just touched, let's just count that one. Nice entry for a short. So remember, we're looking at a higher time frame, the H4, on the M5 or M15, we would have entered, got in and out of that nicely. Almost another touch here. We get a nice touch right here for a short. A nice touch here for a long. Short, 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 long. So these are high quality setups looking on the 4-hour chart. Very good for looking for a higher time frame, and then we got our low time frame for entries. Now let's have a look at the M5 chart and see what we see. Alright, so this is me zoomed out as much as I can on MetaTrader on the M5. So this is only showing 1 month of data compared to the 6 months I had on the 4-hour by zooming out. So this is 1 month. This is 6 times less than the last one. And we've got just over double the times we've touched it in 6 times less of the time. So this is the M5 chart, and as you can see, we hit our 70 and our 30 levels 23 times. So you can see over here, we've come massively above our levels, and prices continue to come up because this is chop. Same with over here, it's continued up. Down, you might have got a nice entry on that, but overall, we're getting a lot more entries, and these entries can get dangerous, especially if you're trading all 22 pairs. So as you can see on the higher time frame, our systems and indicators are slower to react and they give us less chances to trade, but we also know that higher time frames give us more reliable signals. So it makes sense that we use a higher time frame to spot opportunities or to gain a directional bias from. We can then execute our trades on the lower time frames when we see setups happening and get the best possible entries. So we have the H4, we'll have our confirmation, let's just say the RSI above 70 for sells and below 30 for buys. Now we jump to say the M15 or even the M5 and we wait for our next signal. So part 1 of our trading plan will be wait for that. Part 2 will be maybe a moving average cross on this time frame. So we're using the higher time frame for part 1 of our setup and then the lower time frame for part 2 or entries and exits of these positions. So just to show you guys a really brief quick example, I want to do a 3-month test on NZD/USD. The first test I've run using my bot did 1-hour extensions of 70 and 30, all other parameters are the same, and the second test I used the 4-hour. Alright, so I've done a test and here's some stuff I prepared earlier. So here you go. So this is the 4-hour extensions. So notice we got in 18 trades. 18 trades and we made $2,000. So we only got 18 trades and we made $2,000. Now on the 1-hour extensions, we got in 42 trades in the same time period. So we're getting more entries. We actually did end up making almost double the money. However, if you ran this over a longer test period, the drawdown would be substantially more than if you waited for 4-hour extensions. So this is just an example of just the amount of trades you take, the difference. Higher time frames for candlesticks are a big factor as well. If you're looking on the M5 chart and you see 3-bar reversals, they're not going to mean as much as if you see them on even a 1-hour chart or a 4-hour chart. The higher the time frame you go up, the more reliable the signals are, and that's important to remember. So candlesticks on higher time frames are more meaningful and reliable than those on lower time frames. A daily candle includes all the price action from an entire day. It reflects stronger market sentiment than, let's say, a 1 or 5-minute candle. Lower time frames will be spitting out candles, and candlestick formations support resistance levels everywhere. Keep it simple and don't overthink things. Don't get paralyzed by analyzing too much. So use higher time frame candlestick patterns to confirm your trade direction, then look for precise entries on lower time frames. So much like candlesticks, key levels such as support and resistance, wide range bars, and breaks of structure are more reliable and they hold more weight on a higher time frame. So higher time frames will give you clear, more reliable view of market structure, and it's critical to understanding where price is going to be trending or going long term. So scalpers don't look at higher time frames because they're in and out of the market quick. Now if you're swing trading, you need to look at the higher time frame. Support and resistance zones are drawn on weekly charts compared to daily charts, tend to be more respected. So this is just purely an example. If you're waiting for weekly support and resistance levels, you're going to be waiting a very long time. But when you do get those entries, they're going to be really fucking reliable. So this is the same with daily highs and lows or daily support and resistance levels compared to, say, the M5. You wait for it to reach support and resistance on the daily, and then you look on the M5 or M15 for your entries. I've said this a lot throughout this video, but you really need to remember this. Higher time frames are more reliable. You're going to get in less sticky situations if you're using higher time frames. Don't look too deep into every time frame. You will get confused. That's another key point. If you're looking at every time frame is going to have a different candlestick, and you're just going to be confused and possibly scared, which can get you out of positions early, which is no good. You need to stick to your plan. So let's just say you enter on an M15 short and the candlesticks are coming down nicely. You look at the hourly chart or the 4-hour chart now, and you see that the candle looks like this. Now, you get scared, you exit your position early, so you take less profit if you were in a short, and by the time this 4-hour candle actually closes, it looks like this. So you scared yourself by looking at a different time frame where your trade would have worked out and you would have made more money if you just held it and stuck to your plan. And hopefully you also know about the different time frames that traders use, and that it's good to look at higher time frames, especially when you're working a full-time job. You don't have to look at the chart that much. And that pretty much does it for the video. So thanks for watching, and I think we're on lesson 5 now. 5 out of 18 I think I've got planned. So if you want to see more, subscribe, and just more free stuff like this will keep coming out. Cheerio!